You can do as much technical analysis as you like, but the truth is, interest rates are what really moves the market. My name is Connor Woods, and in this video, I'm going to show you how to interpret interest rate data and understand the effects it can have on the particular markets that we all trade. I'm also going to show you an example or two of just how much the markets move off the back of interest rate data. Interest rates play a critical role in financial markets, affecting the behaviour of investors and the overall economy. The level of interest rates can impact everything from the stock market to housing prices, as well as the value of currencies as well. A lot of these markets are ones also that we trade on a day-to-day basis. So why are people not giving it the attention it deserves? Maybe it sounds too complicated. Well, that's why I want to break it down very simply for you now. Okay, so to begin with, let's try and understand what interest rates are and how they work. Interest rates, really simply, are a reward for saving and a cost of borrowing. Think about it. When someone borrows money from a lender, you're charged a certain percentage or certain rate of interest on top of the amount that was borrowed. Therefore, the higher the interest rate, the more that cost is of borrowing, but the more reward you get for saving, like in your bank account. Interest rates are then set by the central banks, like the US, the Federal Reserve, or the European Central Bank, or the Bank of England, and so on. And they're influenced by a variety of factors, to be honest, including inflation, economic growth, and all of the individual economic events that we get in our monthly calendars. At the end of the day, though, all of these factors lead to the same question. What will this mean for interest rates? And that's what drives the market, expectation. So when it comes to the impact on the certain parts of the markets, let's look at how interest rates can impact the overall economy first of all. So when interest rates rise, and I've drawn a really nice simple diagram hopefully to see. When interest rates rise, borrowing becomes more expensive, as we know, which can then reduce the amount of credit available to businesses and individuals. This slows down economic growth and can lead to higher employment due to that lack of investment, and therefore lack of investment, lack of economic output. Conversely, when interest rates fall, borrowing then becomes cheaper. That means that more people are willing to borrow. That can stimulate economic growth and job creation. Therefore, when you think about why central banks would change their interest rate, it's all to do with, where we are in the economic cycle. If an economy is overheating, inflation is high, it's in the best interests of the central banks to increase interest rates, i.e. tighten the policy, to basically stop the flow of money circulating around the economy to bring inflation down, i.e. essentially what that means is to slow down the economy. Alternatively, say the economy is really weak, there's a recession, it would be in the best interests of the central bank to then lower interest rates to basically stimulate the economy, encourage spending, encourage borrowing. That generation of spending and investment will help improve economic growth. Now think about that. When it then comes to, the markets that we trade, stocks, currencies, commodities, anything like that, let's have a look at the impact on those. Hopefully this diagram is really clear to see what the start goal is and what the end goal is. So let's follow it through. A way in which interest rates, impact financial markets is through the effect on the stock market, first of all. When interest rates fall, it becomes cheaper for companies to borrow money to finance their operations, which can then help boost their earnings and therefore their stock prices. And conversely, when interest rates rise, companies can't borrow as cheaply, which can then lead to lower investment, lower earnings, layoffs, etc., and then therefore lower stock prices. And you can see how that flow diagram goes through there. When we're talking about currencies, the foreign exchange currencies that we trade, interest rates, have an impact on those as well, as they can influence the flow of capital between countries. For example, let's say interest rates in a particular country increase. That can then attract foreign investors looking for higher returns on their investments. This can then lead to an increase in demand for that country's currency, because if you're going to invest in another country, you need to invest in their currency essentially. This can then cause its value, the value of the currency, to rise relative to other currencies. But remember, this is a theoretical standpoint. And in reality, the relationship between interest rates and currency valuation, I'd say, is a little bit more complex. It's influenced by a lot more of a variety of economic factors, inflation, economic growth, political stability. We have to try and take everything into consideration. But as a standalone, that is the typical flow that we see of interest rates impacting currencies. Let's take a look at an example. Okay, so here is a chance to win a 3 months membership into our trading room. So I've just explained what interest rates are, and there's a key definition that we must understand in order to move forward. So let's test that. Which of these is the correct definition of interest rates? Is it A, cost of saving and a reward of borrowing? Is it B, a reward for saving and a cost of borrowing? Or C, a reward for saving and a reward for borrowing. Comment what you think is the answer for a chance to win. Okay, so let's look at one of the clearest examples, on the cleanest relationships will be interest rates on the US dollar when it comes to the Federal Reserve's interest rate decisions. So we'll get interest rate decisions from central banks every single month, and you'll just have to check your calendars as to when they come out. We have it at a particular time each month. We've got the Bank of England there. You can see that the official bank rate, sometimes it's called. In the US, it's called the federal funds rate. These are all just interest rates. The Australian Reserve Bank of Australia cash rate. Now, if we're using the example of the Federal Reserve for now, because it's the biggest economy in the world, so we want to check that example as probably a priority. It's probably the biggest one. Now, I've just got all of their interest rate decisions dating back to April 2021. The forecast in the middle, previous on the right, and the actual on the left. Now, the first thing we want to look for is when the interest rate decision comes out, is it the interest rate higher than expected, lower than expected, or in line? And generally speaking, what you'll find is it's normally in line. There's not normally too many surprises. But you can get surprises, and then we can get some really good market moves. Let's go back to June the 15th, 2022. The Federal Reserve decided to increase interest rates to 1.75%, forecasted though at just 1.5% and previously at 1%. So a 75 basis point hike, and it was more than expected. And as you just explained, that increases the value of the dollar theoretically. And then when we scroll back to that time, when was it, June, look at the performance of the US dollar over the next few months after that increase in expectations on interest rates. You can see how the dollar absolutely shot to the upside. Now, when we scroll over to something a bit more recently, and this is when it's a good thing to check is market expectations, because what you'll sometimes find, or a lot of the time find, is it's in line with expectations, and you say, okay, do I sell or do I buy? Then it's about what's already been priced in, and I've got a really fantastic FedWatch tool that you can watch. It's called the CME FOMC FedWatch tool. And essentially what that tool does for you, it's a website, it's free, is it basically tells us what the markets think, or where the markets think interest rates will be at the next meeting. So you can see at the moment, we're in the current 525 to 550. That's basically 5.25% to 5.5% interest rate. At the next Fed meeting on the 13th of December, the markets think there's a 99.7% chance that the Federal Reserve are going to keep rates where they are. So obviously now we know any change in either direction is going to cause a significant reaction on the US dollar. But in the most previous meeting, what we've had previously, and I can't check the expectations for previously, unfortunately, but I can tell you that the markets were actually expecting another hike. So this actually a few months ago looked more like probably 50-50. So 50% of the markets thought that the Federal Reserve were going to increase interest rates, and 50% thought they were going to hold. That slanted towards the hold, as you can see, quite significantly. And when the Federal Reserve then come out and basically in their last meeting decided to keep rates where they were, the markets saw this as a disappointment. The markets were sort of expecting another hike by the end of the year. Looks like they're not going to get it. What happens to the US dollar as a result? During that time of expectation, you can see the increase in the value of the US dollar. In the time where the markets were, say, disappointed by that, or the markets were wrong about that, you can see what's happened to the US dollar as a result of that. It started to sell off significantly. We now know interest rates are critical in financial markets, impacting everything from stock prices to housing prices and the overall economy. Understanding how interest rates work and the ways in which they affect these financial markets is essential for us as traders, as it's the real driver for trends. Having sound knowledge of this alongside technical analysis will mould a brilliant trader who can benefit from larger moves in the markets. Don't forget, if you like this video, please feel free to like and subscribe to our channel. And remember, you can trade interest rate decisions from central banks with our partner in broker Switch Markets. Until then, trade well, and we'll see you on our next live stream. Did you know interest rates are the biggest driver of financial markets, yet some people choose to ignore it? Are you someone who wants to know about how interest rates affect the markets, but maybe finds it boring or complicated? Well, on the Forex Signals TV YouTube channel, I've just released a video explaining how you can trade interest rate decisions and expectations in a clear, simple manner. Go and check it out and let me know what you think in the comments.